Call to order the January 18th, 2024 meeting of the Federated Retirement System. And we will begin with a roll call vote. Sorry, not a vote, simply roll call. Vice Chair Jennings, are you here?
Here.
Very good. Trustee Abbott?
Here.
Trustee Avasti?
Here.
Trustee Chandra?
Here.
Trustee Faulkner?
Here.
And Trustee Linder?
Here.
All right, and I am here. Maytech, would you like to qualify those who are attending remotely?
Yes, that would be great. So, Trustee Jennings, are you teleconferencing from the address 855 East Hilton Drive, Boulder Creek, California?
Yes.
And is the location ADA accessible, and can the members of the public be heard from that location?
Yes.
And have you posted the agenda on your, outside of the location from where you're teleconferencing from?
Yes.
Thank you. She's qualified. Trustee Linder, are you teleconferencing from the location 1251 Shiloh Ridge, Windsor, California?
Yes.
And is the location where you're teleconferencing from ADA accessible, and can the members be heard from the location from where you are?
Yes.
And have you posted the agenda outside the location from where you're teleconferencing from?
Yes.
Thank you.
Thank you.
Thank you, Maytak. A few ground rules. This is a hybrid meeting, so all votes will be roll call votes. On orders of the day, I'm just going to note that item 4B is a presentation from an outside party, and they have requested a 10 a.m. start time, and we will move to accommodate that. Hopefully, we will take a break right before that, prior to that 10 a.m. presentation. And I believe we have to waive sunshine on a few items, and that is indeed the presentation from, for item 4B, and that is the only thing. So do we have a motion to waive sunshine?
So moved.
Do we have a second?
Second.
And any discussion, any public comment? If not, we will have a roll call vote. Vice Chair Jennings?
Aye.
Vice Chair, Trustee Abbott?
Aye.
Didn't mean to promote you there. Trustee Avasti?
Thank you.
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well, so sunshine is waived. At this point, we will have public comment. Any members of the public who wish to comment on items not included on the agenda, provided that the matter is in fact within the subject matter jurisdiction of this board, may do so now. If they are present in the room, or if they are on Zoom, they will be permitted to speak for 3 minutes. Is there anybody on Zoom waiting to speak with their hand raised? Okay, seeing none, we will move to the consent calendar. Any items that anyone would like to pull from the consent calendar?
Yes, Mr. Chair, I would like to pull, if you bear with me for a second,
Mhm.
item 2.5A.
2.5A. Okay. Any other amendments to the consent calendar? So with, bearing in mind that one amendment, so we will hear that as a distinct agenda item, do we have a motion to approve the consent calendar?
So moved.
I'm sorry, was that Trustee Faulkner? Trustee Chandra? Okay, hearing it out of my right ear. Is there a second?
I second.
And we have a second from Trustee Abbott. Any public discussion? Any trustee discussion? Vice Chair Jennings, how do you vote?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye. Passes unanimously. And we will now go to our next agenda item, which is closed session.
Mr. Chair, the item that was pulled, can we, I just wanted to make a comment, so then it can be approved as well by the board.
I see, okay. Very well.
Yeah, so just wanted to, this is regarding the PAFR, which is the report that is, the condensed report that is issued by the office. I just wanted to know, this information will be changed on page 5, under the benefits payments and funding progress. There is a table on the top left-hand corner. If you see, it includes creditor service, average monthly final, average salary, and average monthly benefit. The monthly benefit for the 0 to 5 years reached $7,813. That's a mistake. So we will actually have that fixed before the PAFR is issued to all stakeholders. I just wanted to make that point. So if you could approve the item, noting that that will be changed, that would be greatly appreciated. Thank you.
Okay, I did have actually one more question about it. I'm trying to call up my copy of the PAFR. I gotta
Sure.
get online here for a second. So, Where is the city's Wi-Fi? There we go. If you can bear with the chair for just a moment.
I also wanted to mention that on page 3, on meet of the Board of Trustees, that's a pretty nice looking group there with those pictures.
Is that up for vote?
No, it was just a statement.
Random observation. Okay. Yeah, my question is on page 5. I believe in the past, we show the progress towards funding, and we show at the top of this graph the 58% for 2023.
Correct.
So that is indeed the number for fiscal year ending 2023. I believe in the past that was offset by a year. I believe that's because the PAFR came out a bit earlier in the schedule. So is this unlike past years where it is actually up to date? Are you following what I'm saying?
No, I'm not
Okay.
clear on the
I
question.
believe in the past, when we've had the PAFR, that in fact, we only showed the 2022 numbers.
Oh, in other words,
th-
that
th-
this
there
is the
was-
first year that for the PAFR, we actually include the 58% for 2023.
Right, that's what I'm thinking.
Yeah.
I believe that's true.
I believe, Barbara, do you know the answer to that question? I believe that it is 58. I believe it's based on the most recent valuation. I get your point now.
I believe in the past, we had some sort of a caveat, a footnote denoting that there was an offset. We showed the dollar figures for the fiscal year just ended, but the funding ratio was only showed through the
Oh, so you mean it
year
was a
past.
roll forward version? Yes,
Yeah.
yes. I think this is the roll forward version. It's based on the assets numbers, but the evaluation has not been completed. But you take the assets number based on the funding ratio from the prior year, and you roll them forward, assuming you met all the assumptions. So the actual funding ratio for 2023 may be a little different than 58.0, maybe 58.2, or just a.
But that's then largely an accident of the fact that the ratio hasn't changed that much this
That's
past
exact,
year.
that is correct. Yeah,
So I
that's a
guess
roll
I'm
forward
wondering,
number.
do we still need the footnote that, or the side note that we had previously included on this?
So Benji is actually traveling to the meeting. Benji
Okay.
is the accounting manager, but we'll make a point that in addition to the change that I just noted, we'll ask the question, and if we
Okay.
need to add any further explanation on the note, we will certainly do that.
Great,
Thank you, Mr. Chair.
okay. With all that,
Roberto, I have a question.
go ahead.
What is the number on this chart that's changing? Can you remind me of what
Yes,
you said?
on the top left-hand corner, the
Yeah.
average monthly salary for the credited service of 0 to 5 years, that number is incorrect. It's not $7,813. It's lower than that. I don't have the figure in front of me, but it's certainly not that number.
Roberto, I actually think it's the headers are switched. The two headers need to. That's what Benji
So what
had.
you're saying, I apologize. So what it is that the average monthly benefit should be on the middle numbers, and the average monthly salary is on the right-hand side.
That's correct.
So the headers are actually in the right location, and the numbers are the ones that are in the correct location.
Yeah, but
Okay.
she switched the headers.
Thank you, Mr. Chair. So
Okay.
I apologize. The correction should be, we're gonna change the numbers from the.
So the monthly, monthly benefit is going, especially in Federated, the monthly benefit will be less than the monthly final salary because no one gets 100%.
Correct.
Yes.
Correct.
Most at 75, and from 0 to 5 years, it would be 10%.
Correct.
Or
So
it would be a little higher if you're tier 1.
in other words, the average monthly salary are the numbers in the middle column, and the average monthly final average salary are the numbers on the right-hand column.
May I make,
Okay,
may I
that
make
makes
a
sense. Thank you.
suggestion?
Please.
So is there a deadline that we must post a PAFR by?
No, but we just wanted to make the call that change will be made. I'd rather not have to come back here to
Okay.
bring the next
Well,
printout.
I think I see where Maytac is going with this. I'm wondering, since there are a couple of things we need to check and change, can we simply approve this next month and we have a final clean version.
You certainly could do that. I honestly don't think is necessary, but if that's what your preference, certainly we can do that.
That would be my preference. Is
Sure,
there-
no, that's.
Is there a
this
motion?
is Your prefer, so that's fine.
Oh, you can just go ahead and defer it.
I can just defer it, okay? Deferred. Great.
Are we gonna change the pictures too?
Those probably need to be
We have
updated
time
and
now to
improved.
change the pictures, yes.
I believe, have we authorized the use of any Photoshop? Okay. Was that when I had a full head of hair? I missed it.
Yeah.
Okay, with that, and all levity aside, it is time to go to closed session.
Recording stopped.
The public portion of the meeting, and I believe the next.
Recording in progress.
Thank you. I believe the next agenda item is 3, death and survivorship. We have a moment of silence for those who have served the city and who have passed. Thank you. The next item is.
Before we, pardon me, before we move on from the closed session item, I just want to note for the record that Reed Smith has recused herself from the closed session item, as well as I do want to ask if there's any reportable action.
There are no reportable actions, and yes, thank you for pointing that out, and Reed Smith was recused from the closed session. Mr. Pena?
Yes, no, I don't, just wanted to remind you about item 1A, which is the application for a change in status for a service connected disability.
Oh, do we need a separate vote on that?
Yeah, that is not part of the consent, so it needs to be
I see.
approved separately.
Okay, thank you for that observation.
You're welcome.
So this is, there was, I guess, a disability hearing, and the Disability Committee recommended denial for this application. So we need a motion and vote
Yes, I
to
mean,
approve.
Obviously, there any discussion
Mhm,
or any questions,
okay.
otherwise, motion.
Is there any discussion or comment on item 1A? So we would need a motion to approve the denial as recommended by the Disability Committee. Do I have such a
I'll
motion?
move that motion, Mr. Chair.
Thank you, so that's. We have a motion from trustee Linder, second from trustee Faulkner. Any discussion, any public comment? If not, then Vice Chair Jennings, how do you vote?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well, so the denial is approved. And now, at long last, we come to item 4A, which is an oral update from our CIO.
Thank you, Mr. Chairman. and
We did.
We did, it was
Before
approved.
we close session.
Yeah. Yeah, we just snuck that one back in.
Thank you. Good morning, trustees, and for the nth time, Happy New Year. I was told I can say that till 31st. We have a very light agenda. We do have a presentation by the CIO of Morgan Stanley to give a macro overview on the markets. And he is not available till 10 o'clock, so at 10 he will call in. Meanwhile, I do have some numbers. The Fed pension system was up 2.93% fiscal year to date as of 2 days ago, and the healthcare trust was up 2.1%. These are from Makita. And also, for the record, I wanted to note my appreciation and thanks and gratitude to Council Leaderman, this being his last meeting, I believe, at San Jose, and I have benefited immensely from his wise counsel in the last 6 years, so we will miss you, Harvey. With that, I'm happy to take on questions. I will come back at 10
Okay.
when Morgan Stanley is back on, and I'll introduce the speaker at that time.
Well, let me, echo the sentiments of Mr. Polani in thanking Mr. Liederman for long and wise service to the board, and hope he will remain in our Rolodex for future consultation, as the case may be. I did have a question about the numbers. It seems we're running about somewhat less than 50% beta to U.S. public markets, and in the past, we've run at a higher beta. I assume that's largely because private markets are still in a mode of being marked down, but I don't know if you had any further comment on why the numbers are
Yeah,
running.
I mean, firstly, I would take these numbers with a grain of salt. These are very approximate numbers, and
Mhm.
these are as of 2 days ago. We've had a rough start to January
Mhm.
in terms of the broad U.S. markets.
Mhm.
If you factor in today's performance, we'd probably look a little bit better. So
Mhm.
these are very rough numbers, which directionally, we want to know where we are. But you are right that private markets are lagged, and these don't take into account the
Mhm.
private market effects.
Okay. Any other questions from trustees or from the public? Anybody online have their hand raised? No? Okay. So we will delay item 4B for the moment and move on to, and since there's no old business, we'll go to new business, oral update from Mr. Pena.
Thank you, Mr. Chair. If you bear with me, just a couple of comments. So this is January, which means the staff is working on the retirees 1099 for calendar year 2023, and they will be mailed at the end of this month. The guarantee purchasing power for 2023, which is a benefit that actually brings retirees to a 75% of the purchasing power protection based on the year of retirement, that will be actually included in their paychecks for February. The calculation has been completed, and we received that from Chiron. A couple of more items. The city COVID-19 mandatory vaccination policy was discontinued effective January 1st. Just wanted to let you know. Our offices will be closed on February 9th, Lunar New Year, and also on Monday, February 19th for President's Day. The January edition of the newsletter has been mailed, so you should have been able to see it by now. I also wanted to let you know that the City Information and System Security Policy 1.76 that was recently adopted by both boards was revised on December 5th by the city to add a requirement that departments with a dedicated IT team, which ORS has, designate a cybersecurity person to ensure compliance with city standards. And we have designated our IT manager, Shilpi Dwivedi, as the cybersecurity manager for our office. Lastly, in closing, I just wanted to echo the words by our CIO in regards to Harvey. I met Harvey some 21 years ago. I knew of him many years before from the 1990s from Orange County and his work at Orange County and litigations all across the state back then for retirement systems. And it's been a real pleasure working with you, Harvey. In fact, I am here today in grand part because Harvey reached out to me to my old job back home in Puerto Rico to let me know that this position was coming up available and if I was interested in applying. So
I will not take the blame for that.
no, understood. So again, it's been a real pleasure working with you for the last 20-some years. You have been instrumental in a lot of the jobs that I have worked on with the boards. I always have found that not only your legal analysis and input has been helpful, but I think I have shared with you in the past. You have also offered recommendations and suggestions that go beyond the legal analysis, and I always been very thankful for that. So, again, it's been a pleasure, and honestly, from the bottom of my heart, I wish you a very long and healthy retirement. And just a reminder that these are public meetings. If you find yourself at home with nothing to do, you're certainly welcome to show up. You could do it by Zoom, but you could also take a ride and sit down here and get some coffee and make some comments from the public. So best of luck to you, and thank you.
Can I just add on a personal note? I know everyone's spoken on behalf of the plan, but it was drinking from a fire hose when I first joined the board, and you were incredibly helpful. I think I finally have the hieroglyphics of Chiron figured out, but you were definitely instrumental in helping me understand the whole actuarial world. And when I joined, we had the overpayments debacle. So I had to have a lot of sidebars with Harvey, for which I'm grateful.
I'm sure Chiron is cringing at the thought that I explained it.
Okay, well, thank you, Mr. Pena. Are there any other questions or comments from trustees? Any questions or comments from the public? If not, we'll move on to 6B, which is an oral update from City Council. I see that Councilmember Davis is not here. Is there anyone from office to, okay. Okay, well then indeed it is time for Chiron. Item 6C. Discussion and action on the final OPEB valuation. Let the hieroglyphics begin.
Yeah, we brought new hieroglyphics for you.
Just give us some hand signs.
Yeah, you
Wait,
can use
Harvey.
the interpretation over here. Let me share my screen here. All right. So we're here with the final results of the 2023 OPEB valuation. This is the end of our regular actuarial schedule. So we'll do the.
That means time's up.
Time's up, yeah.
That was a bit quick, Mr. Chair.
Sorry about that. My apologies. I'm not going off.
We also have a short letter with our 5-year projections that are used for city budgeting. But the primary thing we have is the final OPEB valuation results. And so just like with the pension plan, the main purpose of this valuation is to set the contribution rates for fiscal year end 2025. There are a couple differences with the OPEB compared to the pension. One is that we are only determining the city contributions. The member contributions are fixed in statute. So they're just fixed at 7.5%. What we do does not affect their contributions. The other thing to keep in mind is this plan is largely closed. The full benefits are only available to Tier 1 members who did not elect to join the VEBA. So it's a closed and shrinking group, unlike the other plans. There is a catastrophic benefit, but only for service-connected disability, and it only provides benefits to age 65, so it's a very small benefit. So the plan is primarily closed. There are also two pieces really to the benefit. There's the explicit subsidy. We provide a premium subsidy for retirees. But there's also an implicit subsidy that is paid by the city through its active health premiums. And it's because the retirees are generally older than active members, and their healthcare costs are generally higher. And so that implicit subsidy, we occasionally mention it, but it's not part of the pre-funding. It's on a pay-as-you-go basis. So our focus is primarily on that explicit subsidy, the premium subsidy. We showed you these numbers last month in the preliminary. Nothing has really changed. The chart on the left shows the liability measures in the bars and the assets as the line. Both went up this last year, but the liabilities went up faster than the assets. And so as a result, on the right-hand side, we have the contributions. And the contributions are higher than we had projected in the last valuation, but not a whole lot higher. The other thing I'd note that is also different with the OPEB plan is you see the red line at the bottom there. That represents the normal cost. That's the cost of benefits for the next year as service. And the member contributions are more than that cost. So the members are paying all of the normal cost plus a portion of the unfunded liability. And the city's entire contribution is going to reduce the unfunded liability. The last thing I do want to point out here is back on the left slide. The scale here is quite different than the pension plan. We are looking at a total of, I think it's 630 million in liability as opposed to the 5 billion plus for the pension plan. So this is a much, much smaller program, which might not always be clear from our charts. Here we're showing the changes in the UAL. On the right-hand side, we show the changes from last year to this year. And so contributions worked to reduce the UAL. We had some investment gains. The big thing that increased the UAL was the liability experience. That's primarily premium increases. And then we also had some assumption changes that slightly increased it. On the left-hand side, we're showing historical changes to the UAL. And right now I've just highlighted the liability experience. So I wanted to note that this year we had an increase in liability for the liability experience. But for the prior 5 years, that's been a reduction in liability. So this is, we've had really good premium experience over the last 5-6 years. This year was the exception. It's come back. If you look historically at what's happened with investment gains and losses, it's been much less consistent. We've got a couple gains there, particularly 2021, but then those gains were largely offset in 2022. I think, yeah, we had 58 million there and 62 million loss. We've also had, over the history, several assumption changes that have worked to increase the UAL. And really the other piece that has worked to drive the UAL down has been the contribution policy. We've been contributing enough to try and drive that UAL down. So there was a benefit change. That's the In Lieu program back in 2018, and you can see the net impact over the years. I'm gonna turn it to Taylor now.
So we looked at this slide on the preliminary results as well. So it's reiterated here. I just point out a few things. The first is the steady decline in active members eligible for full benefits, as well as a decline over the years in non-Medicare eligible retirees. And that's the darkest green section of the bars there. The Medicare eligible retirees have increased over the years steadily, and that's the middle green bar there, starting with 1,864 in 2017 and increasing to 2,311 in 2023. This is another look at membership, and on the left-hand side there, you can see the distribution of active members between members eligible for a catastrophic disability and members eligible for the full benefits, and it's broken out by age band. You can also see how the members eligible for full benefits compares to the prior year, and the prior year levels are shown by those dark blue diamonds. So you can see that those decreased at pretty much every age band in the current year. On the right-hand side is the distribution of retired members by age band in the prior year and the current year. And you'll notice at the younger ages, the numbers have decreased in the current year. So basically everyone that's non-Medicare eligible, so that's consistent with the trends that we were seeing on the prior slide. And at the older ages, they've increased. Now this slide shows projected benefit payments over the coming period of time. So the dark green on the bottom is payments for non-Medicare eligible retirees. And you can see that increase slightly as per capita costs increase, but the counts are decreasing, so that's offsetting some of that increase. Whereas the Medicare eligible benefits are increasing substantially and becoming a larger and larger portion of the benefit as the number of Medicare eligible retirees increases along with the per capita increase. And you can see, despite the large number of members eligible for catastrophic disability, that's a very small part of liability.
Okay, so this slide's looking at the projected assets and liabilities. So the graph on the left, the bars are your liabilities and the green line is your assets. So what you can see is you've got your assets, they're increasing at a very steady rate, and then they suddenly start decreasing in 2038. And it'll be a little more apparent in the next slide why that is, but what it is your contributions are still pretty high until that point, because you're paying off the 2017 UAL base, and once that's paid off, the contributions are going to decrease, so your assets will start decreasing with it. Regarding your liabilities, it's going to increase for the next 9 years before it starts decreasing, and it's got a peak in 2032 of about 708 million. So if you can see the benefit payments versus the contribution amounts, you can see right now they're pretty close together, but there's going to be a huge difference over time. That difference is going to increase significantly. It's not something to be concerned about. It's just you're going to want to pay attention to it because you're going to have to manage the liquidity of the assets of the plan so that you have so that you're able to pay those benefits.
So I think that's all we have on the valuation. We'll take any questions.
Great, thank you. Are there any questions from trustees?
Can you remind us Measure F? Measure F?
Yeah, so measure.
The implications of Measure F.
Okay, so for this plan, there were a lot of things in Measure F, but the reason we reference it is prior to that, the contributions for this plan were negotiated. They were collectively bargained, and they were not actuarially determined. So starting with Measure F, it fixed the member contribution as the 7.5% of pay and gave this board the authority to set the funding policy and create an actuarially determined contribution. And so that's why that we refer to that 2017 UAL, because when we started, we took that UAL and set up an amortization payment to pay it off, and then have been building since then.
That's helpful. Thank you.
Okay, any other questions from trustees? Any questions or comments from the public? Anybody online? No? All right, well, thank you. It says discussion and action, so do we need to accept the report?
Yes.
Okay, so do we have a motion to accept the final OPEB valuation results?
I so move.
We have a motion from trustee Abbott. Do we have a second?
I second.
We have a second from trustee Avasti. Any discussion on the motion? Hearing none, we will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well. The report is accepted. I think we have time while Chiron is here to go to 6D, which is merely discussion on the 5-year city pension and OPEB contribution projections.
Yeah, so I just brought up the letter here. I'm not actually going to go through it unless you have questions, but this is a letter we provide every year that breaks down the contributions over the next 5 years for both the pension and the OPEB into various components. It's primarily used by the city in their budgeting process, but it just reiterates and collects the information from both valuation reports that you've seen the last 2 months.
Okay, any questions from trustees on the 5-year projection? Or from members of the public? Okay, hearing none, I guess, thank you for that presentation, Mr. Hallmark.
Thank you, and Happy New Year, everyone.
Okay, okay. Thank you so much. I see at this moment that Council Liaison Davis has entered the room, and we passed over her usual agenda item, but we will give her a chance for her to address us with any oral update from the City Council.
of city services on the 23rd. And that is, basically kicks off our budget season with a discussion of kind of what the past year looked like. And then we will receive usually in early February, the outlook, the economic outlook, and the projected budget outlook for the next 5 years. So we're getting started with budget season.
Okay, thank you.
Yeah, I'd just like to thank you, Councilmember Davis. She mentioned the 5-year, this is a 5-year report, this is just for Federated. And I forwarded that this morning to the budget director for the city. So he has information now, and once police and fire is available, we'll do the same. So they will certainly use that information as part of the work that they do for the city council.
Your comments raise an interesting question. The city council gets a set of economic assumptions. I wonder if our economic assumptions are the same as the city's? And what are the sources of those economic assumptions?
That's a great question and would be wonderfully answered, I'm sure, by our budget director, Jim Shannon.
Okay, well, I'll make that inquiry.
He actually kicks in, Councilmember Davis can speak about this a lot more eloquent than I can, but he's asked
I can add a little bit.
Oh, well then.
Okay.
Trustee Jennings.
Vice Chair Jennings, and I would like Mr. Pena to finish his thought, but.
No, what I was going to say is that he actually takes that
Roberta,
information.
can you speak into your mic? I can't
Oh.
hear.
Yes, I apologize, Trustee Jennings. He takes the information of the economic estimate going forward and provides the city council some estimates on the impact of revenue for the city, how that impacts sales tax and everything else. So that's the extent.
And who is the he you refer to?
Jim Shannon, budget director for the
I
city.
see. Okay.
Yes,
Yeah.
but I don't know if you want to add anything else, Trustee Jennings.
Jim Shannon gets reports. They have an outside consultant that's been helping them with the revenue indicators, probably for quite some time. I believe this person used to work with Jennifer McGuire when she actually did the job. So, and then it's pulled together by Jim's office. They put together a 5-year forecast that is used for the revenue forecast, which helps build the budget. They're already working on it. I have indicators. I do the capital budget for Parks and Rec, and we've already received some preliminary numbers and bring that into account when we meet with council, such as Councilmember Davis. So it's a long process, usually done from that side. Our vendors are separate, the board versus not. We're an input into the process. And so what we determine, what Chiron pulls together, then that gets incorporated into that. But we are very separate.
Okay, thank you. Any other trustee questions or comments for Councilmember Davis? Any members of the public wishing to inquire? Okay, thank you. We will, I believe we just have enough time if 6E is a quick one. Discussion and action to authorize the CEO to negotiate an agreement between the board and risk strategies for insurance brokerage services.
Thank you. Thank you. So this item is to request approval of a new 5-year contract with Risk Strategies for Insurance Broker Services for a maximum contract of $300,000 to be split with police and fire. Back in August of last year, we issued an RFP for insurance broker services, but no bids were received. So the RFP was issued in response to the internal auditor's findings from one of his audits. However, the amounts listed in the report included the insurance premiums and not just the payment for services. So it was a lot more than what it really is. So after we narrowed down the cost to just the payment for the insurance broker services, it was determined that under city policies, these should be done under an RFQ, request for quote, since it falls between $10,000 and $140,000. So in that case, we issued an RFQ and we received two bids. one from Risk Strategies and one from Epic Brokers. Risk Strategies came in lower at $50,000 per year. So we're requesting that we go with Risk Strategies and approve this agreement.
Okay, thank you. Any questions from trustees, from members of the public? So I guess we need a motion to accept this insurance bid. Do I have such a motion?
Also a motion.
We have a motion from trustee Abbott. Do we have a second?
I'll second.
We have a second from trustee Chandra. Any discussion on the motion? Any public comment? We will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well. The contract is approved.
Mr. Chair, I know
Yes.
you want to take a few minutes break before the next item. We don't have to discuss it now, we can do it after the presentation, but I misspoke, the question that was asked by council on the PAFR. If we delay to February, we got an extension for filing all the information through the end of the month in January 31st. So if it's deferred to next month, we will have to request an extension. And what I will respectfully request is, Benji's here now. We can discuss it now. We can discuss it after the presentation by the investment manager. But quickly, the 2 points I wanted to make to your question, you are correct. The reason this year 2023 is included is because of the timing. We had information prior to finalizing the PAFR, so we included it. So that answered that question. In regards to the table, the numbers are correct. They were just, whatever you want to call it, inverted, switch. So all we're going to do is switch the numbers under the right column. That's it. So with that, I will hope that you will consider approving the PAFR now. We're happy to answer any questions, but Benji's here and she can provide more detail to it. Thank you.
Okay, thank you for those clarifications. Do trustees have any questions, further questions about the PAFR then with those clarifications? Trustee Faulkner?
Yes, just a quick one. From my understanding, it sounds like switching the two columns. Just curious if, according to that, the bottom two columns, the average monthly final salary would be lower than the average monthly benefit. Just wanted to confirm that that would be the case, as was mentioned that typically the average monthly final salary is higher than the average monthly benefit.
Yes, that would be correct. The numbers would be correct. And Chiron can answer that question,
so
why it would be more.
I think the short answer to your question, which is a very fair question, is that their benefit increases with credit service up to 75%. I think these monthly benefits, and correct me, I'm not really sure, it includes cost of living increases that have been earned over time. Benji, do they?
That is correct. It
That is
includes
correct.
COLA, yes.
So when you account for the fact that those are higher benefits and then you have been retired for some time and you include the cost of living increases to a higher base, that's why for the 26 to 30 and 31 years, you will see that the actual benefit exceeds the average monthly salary.
It's good to be retired.
It doesn't exceed.
It's good to be retired for a long time. Yes.
Was there a follow-up, Mr. Faulkner?
No, I just wanted to confirm
Sure.
that that was
Yeah.
the switch all the way across.
Okay. So with that, I will entertain a motion to accept the PAFR and approve the PAFR. Do I hear such a motion?
A motion to accept.
All right, we have a motion from Vice Chair Jennings, a second.
I'll second.
We have a second from Trustee Abbott. If there's any public questions or discussions, any further discussions on the motion? Hearing none, we will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well, so the PAFR is approved.
Thank you.
Thank you.
And with that, I see we have 5 minutes to the top of the hour, and we have a time certain item at 10 o'clock, so let us take a 5-minute recess and reconvene at 10 o'clock.
Recording stopped.
Sorry, what is the time certain item?
The public portion of the meeting. You can go back on the clock. So we are returning to item 4B, which is a market overview from Morgan Stanley. Do you want to
Yes.
introduce the principals, Mr.
Yes,
Kalani?
thank you, Mr. Chairman. And before I do want to let the board know, 2 weeks ago, at the Police and Fire Board meeting, we had Professor Myron Scholes present to the board. And he's a professor at Stanford, an emeritus professor at Stanford. And he's also one half of the Black-Scholes option pricing model that's widely used, and a 1997 recipient of the Nobel Prize for Economics. He gave a superb presentation on the evolution of risk management. And
Okay.
so if you have time, I would urge trustees to go and watch that recording. It's about 45 minutes, really very, very well done presentation on how pensions should think about risk management.
Okay, that sounds very interesting, and my only regret is why we don't have him here at
Well,
our board.
I was going to say you have an equally distinguished guest here.
Of course.
Talking to your board. And I'm going to, I'm sure Rui's on screen, but before I hand it over to him, I'm going to introduce him very briefly. Like Professor Scholes, he has a very long bio, but I'm going to shorten it in the interest of time. So we are thrilled to have Rui Figueiredo, who's the co-head and chief investment officer of the Solutions and Multi-Asset Group at Morgan Stanley Investment Management today. He's also a member of the Global Investment Committee at Morgan Stanley and of the Investment Management Operating Committee. And he has 26 years of industry experience. And prior to joining Morgan Stanley in 2007, he led research on behalf of Citi Alternative Investments. And prior to Citigroup, he was a case leader at the Boston Consulting Group, as well as the Alliance Consulting Group. He has published extensively in finance, economics, law, and political science. He is also an associate professor emeritus of the graduate school and previously a tenured professor at the Haas School of Business, UC Berkeley. Rui holds an AB degree from Harvard and a PhD from Stanford. With that, I'm going to turn this over to Rui and his colleagues at Morgan Stanley.
Well, thanks, everyone. It's a real pleasure to be here and an honor to present to you. I will say, despite what Prabhu said, I've neither won a Nobel Prize or had a formula named after me, so I feel a little bit intimidated with that introduction. But thank you so much.
There's hope.
There's still time.
Yeah, there's still time.
There's still time.
Hang in there.
Exactly. There's always hope. But thank you very much. And I know that part of what I wanted to do was just to give you a little bit of background. I spend a lot of my time, as Prabhu knows, in my role at Morgan Stanley, working with and speaking with large asset owners around the world, pension funds, sovereign wealth funds, endowments and foundations. I also, as part of my role, am actively involved in managing portfolios. So very much, that are multi-asset, that are, outsourced to Morgan Stanley. And so very much sitting in the same seat as Prabhu and others in terms of how should we be thinking about allocating assets over time. And so with that in mind, what I thought I would do, and I think Prabhu, I have about 30 minutes including questions, so I'll try to hit on sort of what I think are sort of some of the big themes, both that I think that are necessary to be dealt with, that we're dealing with in our portfolios, thinking about, and also issues that are related to that asset owners that are similarly positioned as San Jose for thinking about sort of the forward-looking environment. Okay, so with that in mind, I'm not going to go, we circulated a presentation, I'm not going to go through it page by page, but I'm going to try to bring out what I think might be some relevant themes that you all should be thinking about, and that others that are positioned have been talking about as well. So broadly speaking, I think David Biltikoff, who's my colleague, who works with our large asset owner partners in the West Coast, is on with me, and he's going to share the screen. If you just turn to page 5, David, I'm going to start by just giving kind of a quick overview about the sort of the macro backdrop, but then I'll try to drive it down to some of the themes that I think are most important. So number one is, like, if you think about the sort of I'll try to signal a little bit about, give you an overview about what the topics that I intend to talk about. I mean, I think broadly speaking, sort of the market environment has been shifting pretty dramatically, even in the last few days, right? If you went back to the end of 2022, everybody was very negative and thinking about, all of the talk was about hard landing. And then gradually over time, that's shifted pretty dramatically to the end of 2023 to a much more sort of muted sort of picture, much more weight put on the possibility of a soft landing or even Goldilocks type of outcome. Now, even with the recent data that we've seen as we started 2024, people are starting to sort of rethink that again, right? And so, there has been, one of the things that's really been notable as we've come out of the pandemic is that things have shifted pretty dramatically. Like, sentiment has moved pretty dramatically from quarter to quarter, from year to year, and so on. And so where does that put us now? And I think that, broadly speaking, our view is, number one, that the downside has become more muted, right? That it's not that we're out of the woods, that we might not have a slowdown, even a recession, but that the downside for that, if we compare that to some of our experiences, in the dot-com collapse or the GFC, essentially seems like less of an issue. And within that, one of the kind of crucial things is that the Fed, in some sense, is in a different position than it was in 2020, right? Where, they had very little room to move rates down. They had expanded, QE had been going on for a long time. They have corrected some of that. And so, when you think about dry powder, we usually talk about dry powder in the context of investments. If you think about dry powder in the context of central banks, they have more degrees of freedom if the negative outcomes are worse than what the market thinks. So that's number one, which is that, in some sense, the growth picture seems, better than it has been over the last, from 2 years ago, with a lot of negative sort of sentiment built into both the economic outlook and the markets. So that's number one. Second point is, even, saying that, the two other things you have to think about are, where are the risks to that view? One is inflation. And I think people have gotten excited about how quickly inflation has come down, whether you look at, core or other measures of inflation. But it is our view that while we've had disinflation, it becomes harder and harder to bring it down even further, right? The last 25, 50 basis points above target is much harder than going from 10 to 8. And so we're likely to see more inflation, persist than maybe what the market was building in, I'd say, 6 weeks ago, where they were thinking about rate cuts being pretty aggressive. And then finally, you have to think about what does that all mean for the valuation context. And in the valuation context, the second half of last year, and particularly the last quarter, in some sense, reflected those 2 points, and particularly the first point, which was, a more muted downside. And that also pulled forward much of the valuation into the markets. So you put that together, you say, well, the macro environment seems somewhat tepid, actually better than maybe what a lot of people thought, at the beginning of last year. But at the same time, the fact that we have inflation, that we have some growth risk, and that we have, sort of valuation issue, sort of maybe tempers your view about both what you think about on duration, what you think about inflation hedging, and or what you think about markets. So that's kind of the big picture, and I'll go through some examples of that in a second, but then I'll try to turn to some very specific topics from asset allocation that I think are also relevant. One of them being, how do we think about diversification? So one of the big lessons in 2022 that a lot of people took away, I think actually in some sense overcorrected for, was the fact that diversification failed. So I'll spend some time when we talk about the fixed income side talking about that topic, which is, I think, at the center of a lot of discussions around asset allocation. And then finally, I'll spend some time on private markets, talking about both themes in private markets and then sort of where we see both the opportunities and risks in private markets, which is an area we really focus on and have a framework for talking about tactically. So that's broadly where I'll go. If we go maybe to page 1, sorry, the next page, page 6. I'll start off and just go through a couple of those points with some data. I mean, if you look at the data, right, it is certainly the case that the macro data has, in some sense, surprised the market, far more supporting kind of a Goldilocks outcome, low inflation, low rates, positive growth, over the last, 12 months, right? You can see that on the left-hand side. We show, there the positive GDP growth estimates have been revised upward, which basically reflect, that gray sort of block, which is that we keep on getting positive economic surprises. It's also been the case that progress on disinflation has been much more rapid, probably, than what anyone expected, right? You can see that it's definitely disinflation progress is even stronger than the growth surprise. So that's all good, right? Like, that's what created that sort of ebullience, I'd say, in November and December of last year. If you jump to the next page, one of the key points here is that consumption has continued to be a key positive driver of that surprise in 2023. And we put a bunch of data, here, but if you think about, one of the big stories coming out of the pandemic was that there was excess savings. A lot of the consumption has been driven by, dis-saving and under-saving relative to that excess saving that was happening in 2020 and 2021, right? The job market has surprised to the positive. That has also supported consumption, real wage growth. All of that has meant, consumption has been a big driver of the positive surprises on the previous page. And so one of the questions that you might ask is, okay, what does that look like going forward? And, we have probably positive fiscal stimulus. We have positive, job market surprise, some wage growth, maybe tempering a little bit. All of that means that it's likely that sort of, again, that downside scenario is not as negative as some of the other cycles that we've seen. So that's on the macro side. In the interest of time, I'm going to skip forward to page 11.
I have one question. It's
yeah, sure.
One of the things that I have heard is that we're starting to see more defaults on the part of consumers, so that some of the things that were causing some positive things may in fact be those factors with consumers being able to spend may not continue. And I'm wondering what you think about that.
Yeah, look, I think, when we think about defaults, whether it's corporate, and I think the consumer default side is correct, there's no question that those things are slowly ticking up, right? And I think that that's true, right? The question is, like, how high are they going to go, right? Yeah. There's no question that we are coming off of such a low default rate, both on the corporate side and the consumer side, that it's almost asymmetric. It has to go up.
Yeah.
And as the Fed is trying to slow down the economy. I mean, part of this is basically how finally can they slow down the economy. But assuming that they can slow down the economy some, we should see default rates, both on the consumer side and on the corporate side, tick upwards, right? They're going to mean revert. The real question is, like, how high do they go, right? And I'll talk a little bit about this when we think about distressed, credit as a opportunity, or, I don't think that I think we are going to see economic slowdown. Mm-hmm. The question is how, is it likely to be like what they're talking about, like something where we go into a recession? And I think we might see, modest negative growth, but it's just not going to be a large negative shock, is my point. I still am relatively sort of tepid about growth going forward in 24 and 25. I think we will see a growth slowdown. It's just more about how bad is the downside is basically the point that I was making. And I think the point that you make about consumer defaults and also corporate defaults is likely to increase. I mean, so that affects positioning a little bit vis-a-vis credit.
Thank you.
So actually, why don't we turn to page 12, just in the interest of time. I want to emphasize, another point, which is, we do expect disinflation to continue, right? These inflation pressures, some of which are supply side, some of which are demand side, are receding, certainly the supply side in particular. There's also some downward pressure on shelter, CPI, probably driven by, weaker wage growth, lagged effects of falling rents, and so on. All of that said, right, which means that we're not likely to see a repeat of the spike in inflation that we saw in 2021 and 2022, doesn't mean that the Fed is going to be able to get us all the way down to target quickly. And so that's another sort of, in addition to what you were just saying about defaults, is a reason why we don't want to be, exuberant about the forward-looking environment, right? Like, they are trying to bring down inflation. My own view is that if you're sitting at the Fed and you have this asymmetry, you have this choice between, overshooting on being too aggressive on inflation and undershooting, given how we arrived here, my perspective is that they're likely to be a little bit more cautious. And much of the language that you've seen from the Fed, once the market came out and said, we think there might be 6 rate cuts in 2024, all of that is getting walked back right now. And I think that that's a reflection of that sort of asymmetry in their preferences, right? So again, the likelihood that we're going to see, dramatic, there are two paths to rate cuts. Right? One path is we have a negative growth shock. The other one is that everybody's comfortable that inflation has been tamed despite growth not coming down, that we had a perfect sort of landing of the plane. And on that second category, which is more likely in terms of a macroeconomic scenario, our view is that the Fed is likely to cut rates, but at a slower pace than what the market was building in, like, say, in December, okay? Mm-hmm. So because a combination of inflation is going to be somewhat persistent, right? Like, particularly demand side inflation is not that easy to tame once you start a cycle. And then on top of that, put this asymmetry in where the Fed is likely to fall, means that the rate of rate cuts, particularly even on a path where inflation is just sort of leveling but not hitting target, is likely to be slower than at least what the market anticipated going into this year. So keeping what is the implication for asset allocation? It has implication for rates. It also has implication for thinking about sort of inflation hedging assets in your portfolio. So if you turn to the next page, I think maybe what I'll do is I'll go to talk a little bit about each of the asset classes, and particularly about from an asset allocation perspective. So if you turn, to the next page, I want to talk a little bit about fixed income and equity in the context of diversification. And the reason I want to do this is because it's a topic that I'm sure you guys have been thinking about. It's definitely a topic that almost every asset owner I talked to spoke with me about consistently throughout 2023, and it persisted in 2024. And basically,
I'm sorry, which page number are you on?
Sorry, on page 14. This page was not in your deck. I actually added this afterwards. So we'll recirculate a version of this.
You're right, thank you. Kirby was furiously flipping here.
It's just a couple pages that I put in. So this is page 14 in my deck. It comes after page 13 in your deck. So one of the big questions was that if you look at 2022, this was an extremely challenged year for portfolios, sometimes called 60-40 balanced equity fixed income portfolios, because the stock and bond correlation was extremely high. And so if you look at 2022, what ended up happening was, stocks fell, close to 20%, but bonds also fell about 13%, which meant that portfolios that were diversified using bonds as diversified against stocks fundamentally failed, right? And so that has caused a lot of asset owners to say, what does that mean for the future? Can we rely on that kind of diversification between equity and bonds as a way of managing, risk in our portfolios? And what we would say is, a couple points. If you turn to the next page, David, what this page shows is, the bonds and stock returns together, over roughly a 100-year period. And what you see there is that in periods where stocks fell, right, which is the light blue bars, right, what did bonds do in those years? Those are all the years where stocks were negative. And in almost every year, bonds were positive, right? Whereas if you look at 2022, it was a huge outlier, right? We had a massive fall in the stock market, 18%, but we also had a large drop in the bond market. You know, here we're using the U.S. Aggregate bond index fell like 13%. So notice that that was an outlier, right? Like, and so the question is, what happened? What happened was we had a very positive, you know, to many people a surprise on inflation, which both drove up nominal rates and caused bonds to fall, but also drove up down valuations because discount rates went up for equities. But that was very unusual, okay? So that level of highly correlated stocks and bonds was also very, very unusual, as you can just even see from the data on this page. If you turn to the next page and ask, okay, what does that mean going forward? I think what we show here is over like a 150-year period. What is the correlation? The blue one is the rolling 5-year correlation. The gray one is the rolling 10-year correlation. What is the correlation between stocks and bonds over time? And what you see there is, you know, that a couple things. One is, you know, 2022, this is a 5-year, but 2022, when the correlation was 0.6, was extremely unusual, right? 0.7. But the second thing is that the period in the first part of this millennium, from 2000 to 2020, was also unusual, right? The correlation between stocks and bonds for all of that period was negative, right? If you look back over the longer history, the average correlation between stocks and bonds is not negative, but it's low, right? And that's what we think, you know, in a normal inflationary environment where we don't have, you know, a secular decline in interest rates like we had in the first 2 decades of this millennium, you know, that is what we think we're going to revert to, right? If you're looking forward and marking out your strategy, what you can say is, no, bonds do have a role. They do diversify against equities, but not at the level which we've had in the first 20 years of this millennium. Right, it's likely, you know, that the stock-bond correlation will be something more like what's 100-year historical averages, which is something like 0.1, 0.2. So don't throw the baby out with the bathwater. Don't overcorrect to 2022, but also understand that, you know, for much of our investment careers, that the stock-bond correlation was lower than what we would expect. Right, so you can use bonds as a diversifier, but you also need to be thinking about other sources of diversification, like alternatives, like active risk, and so on, as part of an overall portfolio, diversified portfolio approach. Okay, so that's number one. If you think about risk assets, and I'll just jump to that, and then I'll turn to alternatives, because I know we don't have a ton of time. You know, our view on risk assets is, you know, what I mentioned it before, right? And this is more of our shorter-term view, which is that we do think, you know, the big questions on equities, I think, and risk assets in general are, you know, what do you think about the forward macro picture, and how does that define earnings? And then secondly, where are valuations? And I think we've included some charts here, but I will, you know, I'll just refer to them verbally, is that our view is that at least in the short to medium term, right, we think growth is going to slow down, but not, you know, not have significant downside, right? That puts some brake on how bad earnings could get. We do think that there is some margin pressure from inflation that will work through the earnings cycle, which is a little bit of a negative to equity performance. And then we also think from a valuation perspective that much of the upside was pulled into the end of last year. So what we've done in our portfolios is, you know, we brought down our equity exposure, but from a position, I would say, for the second half of the year being overweight. So we've started to temper towards a more neutral stance on equities because of this balance between fundamentals, downside risk, but also valuation. And that's broadly speaking where we are on equities. You know, so we've, you know, essentially what our view is on the equity and fixed income sort of piece of our portfolios is essentially neutralizing both, coming from below on duration on the fixed income side and coming from above on overweight to equities to bring it back to neutral, to sort of position ourselves for the sort of the current economic environment. Okay, with that, I'm going to turn to alternatives, and there are a couple of topics in alternatives that I want to emphasize. if here we turn to, I think it's page 23 in your presentation, so it'll be a couple more pages, David, in ours. So there are a couple of major topics on alternatives and private markets in particular, which I want to hit on, right? There are, if you look at sort of asset allocation trends for private markets, there is a secular trend, I would say, amongst asset owners and pension funds specifically, to have increased their private markets exposure over the last 10 to 15 years. And there's a good reason for that. I think there are two drivers of that. Driver number one is that private markets, provide some premium structurally to investors that can be both active risk and also, importantly, illiquidity premiums. And many investors are below the level of illiquidity that they could tolerate, right? That combined with the fact that the private markets, whether it's private equity, real estate, infrastructure, private credit, have at their own pace become more and more institutionalized and have become more innovative in terms of access points, have both contributed to what I would consider a long-term trend towards higher allocations to private markets. That's essentially the secular allocation trend. But there are also cyclical factors that are important, right? And one of them basically dates back to 2022, the so-called denominator effect. And essentially what many asset owners, and I'm sure you've thought about this as well, is that because of what I talked about on the equity and fixed income side, that you had this correlated shock, drawdown in both equities and fixed income at the same time, in that private market allocations didn't really move, right? Both because of actual, sort of performance, but also you could argue some stale pricing. It created a problem for many asset owners, which is the so-called denominator effect, right? That the total portfolio shrank, right, the denominator, but the market weight, or the capital weight in private markets, whether it's private equity or VC or real estate, stayed relatively flat. And so what that meant was that the private market allocation as a percent of the total portfolio increased dramatically, right? And so we wrote a white paper on this in early 2023, trying to disentangle what were the causes of that. How much of that was real, right? How much of that was because of change in cash flow characteristics, and how much of that was just because of mark-to-market pricing. And what we found was that it was a mix of those things, right? But that our recommendation was that many of those things would self-correct, and therefore, from an asset owner, the two questions that you have to ask are, number one, what should I do if I'm facing the denominator effect, like if I'm overweight my privates? And the other one is, what implications does this have on the broader market, right? And I'll try to address both of those. Our view on the first one was that for asset owners that could relax their guidelines and continue to allocate to private markets, that would solve that problem over time, because much of the problem that was faced with over-allocation to private markets would be self-correcting. But importantly, not every asset owner was doing that. I spoke to a number of large institutional asset owners who basically slowed down or stopped their private markets programs so they could bring them back into balance. That has implications also for private market opportunities. If you turn to the next page, right? So like if you look at, if you go to the next page. If you look at what happened to capital flows, right? The number one thing is that net capital flows if you look at the end of this period in the bottom right-hand chart, in most asset classes, basically slowed down, right? Mm-hmm. So that if you look at fundraising cycles for private equity or for real estate or private credit, they're slower and longer right now. And just to give you a piece of data, our estimate is that, like in private equity, for example, dry powder, which is constantly going up because the market is growing, as a percent of the NAV held in portfolios, is actually at one of its lowest points in the last decade. So that has a sort of a macro effect that also maybe defines how you should be thinking about the private markets. Many people are cautious on private markets. I'll go into that because they either don't have capital to deploy or because they're worried about sort of the macro environment. But one thing to think about is that, as everybody does the same thing, it means that the supply of capital is much lower. And so the opportunity to get into good deals might be higher, right? And we saw that, for example, in private credit in 2023, where at the end of 2022, because the public market in leveraged finance effectively cut in half, even though we were going into an environment that was more uncertain, the terms that you could get, the risk-adjusted returns you could get on private credit were much more attractive. And that's a general theme, I think, in thinking about private markets that it's important to think about, right? In terms of, number one, not slowing down in environments where other people are slowing down. That's number one. And number two is that the forward-looking environment might even, be more attractive as valuations come back into equilibrium with public markets. So that's broadly speaking on the private markets. I can go through maybe a couple more slides if you skip forward. I'm going to skip over this. We have a lot of data, but in the interest of time, I want to. Why don't you go to page 32, I think, in this deck. One more, sorry. So there's one other topic that I want to raise, also from a secular trend point of view, and then I'll go to the market by market breakdown of our private markets perspective. So the other big topic that we have, particularly because at Morgan Stanley we have a very large participation in the private markets in different ways. Obviously, our sell side, advises all the big sponsors, works on M&A transactions. That's totally separate from us. But then our investment management business, where I sit, is a major player in private markets. But then we also have a wealth management business, which is the largest wealth management business in the world, which also is one of the largest, sort of allocators in aggregate to private markets. And so a number of asset owners have come to us and said, there are other trends in the private markets. I talked about two of them, increasing allocations and the denominator effect. A third one is, the emergence of what we sometimes think of as the retailization of private markets. For those of you on the board and on the investment team that have been observing this, you'll see that there are a lot of the larger players have started to launch vehicles really targeted at, creating semi-liquid private equity or aggregating investors that typically did not have access to private equity or private real estate or private credit into bringing them into the market. And so what the asset owners have asked us is, what is the implication for us as allocators to the private markets? So the very first reaction I think that most people have is, that's not a good thing as if you're an asset owner, right? Because now you just have more capital to deploy into the same set of deals. And I think at, first brush, that's true, right? Like all of a sudden you brought in a segment that are providers of capital. The size of the deals and so on is obviously changing, the available market. But in general, you want to be in a situation where you have less competition, less supply of capital rather than more. So at first face, that's true. But what we've seen is that if you look at, take private equity, for example, where are the exits for much of private equity, right? Unless you're at the very, very large cap end, right? The very large private equity sponsors, the downstream, mid-market, small market, whether it's in private equity, in real estate, in private credit, much of their exits are actually to other sponsors. So having money come into the top of the funnel actually might be not that great for private equity in aggregate. It might not be that great for the large cap players because there's now more capital competing for the same deals, but could actually be a really good thing if you're operating downstream, right? Because, it's essentially like a reverse, food chain, right? Like the mackerel eats the minnow and the tuna eats the mackerel and the shark eats the tuna. Well, if you're somebody who wants to be eaten, in other words, you want your company to be bought, it might actually be a good thing if there's more money in the shark, community, because there are more sharks to eat the tuna, to eat the mackerel, to eat the minnow. And so I think that what we might end up seeing is not simply here's more dry powder, that's a bad thing for the private equity market. It might lead to more dispersion between sort of large cap and small cap. As an example, that's an important trend in the future because of this trend of democratization of private markets. So those are some things to think about in the long term when you think about your strategy. It's not so much do we want to allocate to private markets, but given these trends, where do we want to allocate? Do we want to be only at the large end of the cap table, or do we want to be allocating to smaller deals, smaller funds, smaller companies?
I have a question.
Maybe I'll
question.
Stop there. We have a page that goes through each of the private markets categories. I think if you put that up we can take that with questions. But, we basically give our perspective on each of the categories, and I'm happy to talk about that if we have time.
Rui, there's a question from a
Yeah.
board member. If
I
you can
just had-
speak into the
yeah,
mic, I think he can hear you.
Yeah, so I just had a question about whether you're suggesting that it's better to get in early to funds or late to funds. It sounds like you said it might be better to get in later.
What does that mean, early versus late?
Early funding, you're early in the startups versus you go in, maybe I didn't hear it right, but that you sound like you could be suggesting that you might be able to go in and buy things later in the funding cycle. I'm just curious if I misheard.
Yeah, no, I didn't say that. What I was talking about was more about size than I was about stage, right? So what I'm saying is that on this particular topic, right, like one of the questions I think that many asset owners have to deal with, and I actually think, like if you take the really, really big pension plans or sovereign wealth funds, like hundreds of billions of dollars, right, they pretty much have to operate with, just because of deployment, they have to operate with the very large cap players, right? The players that can take, that are raising $20 billion, $30 billion funds, whether it's real estate, private equity, and so on, right? And the reason is because they have to write checks that are $500 million, $1 billion. What I'm saying is that being smaller gives certain asset owners, endowments and foundations, smaller public pension plans, the ability to allocate either to those really big funds or to smaller funds, funds that are 1 billion, 2 billion, 5 billion, right? And implicitly in that, what that means is that the kind of companies that they are purchasing, say in private equity, kind of buildings or projects that they're purchasing in real estate are inherently going to be smaller. All I was saying was that in general, and we've done some research on this, when you're operating with the smaller sort of areas of the market where it's less efficient, those tend to generate higher returns, right, than the very large cap players. That's one fact. Then on top of that, now you have this source of capital, and this is a hypothesis, that is coming in away from the institutional side, away from the ultra high net worth side, a new spigot of capital, but it's primarily going into those large, funds. So that's going to mean more competition for deals for those large funds, but also more exits for those smaller funds to the larger funds that are going to have more demand to buy companies out of smaller sponsors. That's basically the point I was making.
Thanks.
Well, thank you very much. That is a lot of information in a very short period of time. So I'm wondering if there are any other questions from trustees. We've been drinking out of the fire hose in terms of this presentation.
Sorry.
No, that fire hoses are good. Fire hoses put out fires.
Could I ask one just curiosity or thought that you might have on the credit markets? So when you showed the equity, the pages we don't have, when you showed the equity bond relationship historically in the rolling averages, is private credit incorporated into that measure? And then if not, the second piece is, what's the outlook, in your opinion, of then private credit versus non-private credit in terms of finding a deal?
Yeah, so that's a great question. The answer to the first one is we're just talking about the correlation. It's not just credit, it's like the aggregate, so it includes things like treasuries. So it's like a bond index that includes, all investment grade, like the aggregate on the correlation. So that's just on the public side.
Okay.
The question about public versus private credit, that's a great question. And what I think is that, at the moment, there are sort of two sets of dynamics going on, both of which are tempering a little bit, right? These were much stronger going into 2023 than they are going into 2024, but are directionally the same, if not in magnitude, which is, on the one hand, credit itself, like equities, is priced, pretty thinly, right? Like the valuation of credit, like if you look at spreads and so on, it's assuming, I think it's priced fairly, but it's not like there's some excess return, given that you have to, it's basically priced for the macro view that I mentioned. Whereas on the private credit side, it's not, there was also a supply and demand effect, right? Like all of a sudden, much of the sponsor-backed financing that was done in the public markets got eliminated, right? Like the high yield and leveraged loan markets issuance went was cut more than in half at the end of 2022. It started to temper somewhat, but not entirely. So we still, if you're just thinking about credit in general, we would still favor private credit over public credit on the margin because of that, although not to the same degree that we went into 2023. We're still overweight private credit. We're neutral on public credit, but those are things that'll converge, I think, over the course of the next 2 years.
Thank you.
The other big thing on private credit, if you let me in, and this is a little bit more nuanced to answer your question, is that private credit is not a monolith, right? Like there's kind of what we think of as core private credit, which would be direct lending, mezz finance, real estate debt. But then there are all kinds of other, what we would consider more esoteric, peripheral, hybrid credit, where it's kind of a combination of equity and debt, trade finance, transportation finance, consumer finance, so the question that somebody asked me about before. And so our view is, sorry?
No, go ahead.
Yeah, so our view is that private credit is still more attractive than public credit, and that within private credit, the real play was in the core in 2023. Now thinking about more sort of the periphery as a balance, like more satellite types of private credit, is essentially the way that people should be constructing their portfolios for 2024. And that certain areas like real estate debt, right? That's likely to be sort of a more attractive area going into 2024, 2025, given some distress and given some of the trends there, than it has been in 2023. So, within the asset class, we're shifting our views somewhat, conditional on being overweight private credit in general.
Trustee Chandra.
Yeah, hi Rui, it's Anurag.
Hi, Anurag.
Nice to see you virtually. Okay, I'm gonna try and limit myself to 2 questions and make no commentary, because this is, you definitely, you got a lot of my synapses firing after this presentation. Why don't we, okay, here are my 2. Number 1, what is your opinion of the commercial real estate space, specifically, and then any implications for macro across the U.S. economy or global?
Yeah. Sorry, did you have another one? Do you want to give me both at once?
The other one's going to be PEVC, so let's just do this one first.
Okay, yeah, sure. I think, look, in commercial real estate, I think, like, if you look at the actual transaction volumes, I mean, we have direct real estate investors. It's hard to get price discovery right now in commercial real estate, particularly in areas like office, somewhat in retail, okay? So I think that one of the reasons, the macro environment for real estate is actually not that bad, right? We've got really low unemployment. We've had some wage inflation. But then there are these big trends in certain subsets like office, work from home, retail, e-commerce, that mean that you have to be highly selective, I think. It's not, you can't buy the beta in those sectors, and that has, and I don't think that has changed. The right way to play those, I think, probably in the short term is more on the debt side than the equity side. Then there are other areas like logistics, like multifamily, where the secular trends go in the opposite direction, where you've got potential for, inflation, which means the inflation hedging aspect is attractive, where, again, I think it's a little bit more of an alpha versus beta story, but where with the right GPs, you can do actually really well. So I would say we've been more on the debt side than the equity side than we had historically, and we've been very selective about how we approach various sectors. Now, you threw in a sub-question there, which is, what's the implication for the macro economy?
Yeah.
And I do think, like we saw that with, a lot of that talk goes back to March, right? Where, right in all of our, because I live in the Bay Area back door, you had the Silicon Valley Bank failure, and there was this whole recognition that a lot of the commercial real estate debt in the U.S. that's held by banks is actually at the regional level. I think that there is likely to be, could have some credit effect if we saw major distress in the office space on the banks, but it's likely to be contained given what the banking system's sort of capital position is. It's not like the GFC. So, there could be, shocks, but it was amazing how quickly people shrugged off the failure of 3, reasonably sized banks, right? So that gives us some, you know, I'm not saying sanguine, but, you know, we recognize the risk, but we're not sort of over focusing on the downside from that sort of commercial real estate so on. I think it's much more about trying to be positioned to take advantage of the opportunities than it is about worrying about the sort of spillover to the macro. It's our view.
That's encouraging. In this or actually you call it retailization, I sometimes call it democratization of private equity and retail folks coming in. So you painted a picture, I mean, clearly larger asset class sizes usually is inversely correlated to returns, but you're saying that in private equity, you've got this oceanic food chain effect. But in venture, it seems to me, it's actually going to be pernicious because you're going to give a lot of money to the big funds. The sovereign wealths will write these massive checks to the brand name funds that'll have to write big checks into companies at high valuations. I mean, that's what we saw in 2021, 22. But your exits there come from acquisitions, largely from public companies or IPO yourself. And you're a little bit less sanguine on the equity markets, right? So you're not going to have that same market cap power in the public markets. So it seems to me you may be forecasting just a continued disaster for a little bit while longer in venture capital.
You know, look, I am hesitant to talk about this in front of you, because I think you have more perspective on it. I always worry because I'm kind of somebody who works across the entire portfolio when I talk to detailed experts, and I'm sure in the room there are people who know more about real estate than I do and more about, you know, corporate credit. But look, I do think that in venture, the combination of, you know, I think that it's going to take longer. This retail effect, I had not thought of that, but I think that is true there too. I agree with your implication that I think that, you know, I think venture, in the end, venture is more of an alpha game than a beta game in my view, in general. And, you know, being with the right sponsors and right firms that have the right access and can add the right value. So you can still make money, but I think as an asset class, yes, I do think that the forward-looking returns of venture are going to be challenged for a while, partly for the implications that you've drawn out, but also just because, you know, like interest rates, you know, costs, all of that stuff has made it harder for venture to succeed than it was, you know, in 2015. You know, so I think that's right.
Okay, thank you very much.
Great.
But you've added some. This is one of the reasons I love talking to groups like you, is because you've made me sort of think about even the implications of what I myself am saying, which is really, no, it's really helpful.
We'll have to grab a beer, Rui.
Yeah, exactly.
Go down rabbit holes.
Mr. Polani,
Yeah, I had a comment and a question. I'll keep it short in the interest of time. So I agree, Rui. I think the depth of 60-40 was exaggerated. And I hope that we can increase duration and the 10-year will hopefully trend upwards to 4.5 at some point soon. My question though was on emerging markets. Compared to our peers, we are overweight emerging markets. And if you can briefly touch on that, the valuation of emerging markets, both intermediate and long term.
Yeah, that's a great one. And you know, I think on the emerging market side, emerging markets are not monolithic, right? Like if you look, you know, some of the emerging markets last year, you know, again, you have a lot of options statistically, but some of the emerging markets last year were the highest performing markets in the world, right? So it's not a monolith. I think our view on EM in general is that certain parts of the emerging markets are more attractive than others. I think China is mainly about risk tolerance. You know, they're clearly facing slowdowns. You know, the issues related to international sort of trade is going to be highly dependent on what happens in the U.S. election. And so there's just a lot of risk attached. And the question is not about what the returns are going to be, but, you know, valuations are pretty low. But the question is, do you have enough risk tolerance and or risk premium there on China? Whereas in India, I think it's a different story. Like India looks undervalued and is almost the inverse, right? They have the opposite demographics to China. They have, you know, the opposite debt position as China. And they are, you know, essentially in place to sort of replace China if the sort of political economic headwinds that China faces rebound to help India. So I think, you know, our view on emerging markets is I'd say relatively neutral across the category, but it's really important to unpack the box and say, where do you want to be? I think India is probably our top pick right now amongst the emerging markets. We're more cautious on China, and things like Latin America, I'd say we're sort of moderately cautious, more positive on Brazil, but there's a lot of sort of political turmoil. My wife is from Argentina. We spend a lot of time down there, and it's just amazing to see how much political and economic volatility they have, and that's happening throughout South America. So,
great, thank you.
Great, thank you. All right, I'm going to move to the lightning round of questions, and a number of the questions that have prompted me to think through these. You showed us the correlation between stock and bond returns, and when we compare private credit with public credit, I guess I assumed that they were well correlated, but is that in fact what you find? Is public and private returns well correlated or highly correlated? Or do we not have enough data?
Yeah, so I think that if you look at the data, it'll show that they're less correlated than what they actually are. And the reason is because, there's still pricing and so on. I think what I would assume for public and private credit correlations is that they're positive, that they're relatively high, but they're not one, right? Like they're not the same asset class, different composition, different size companies, different sector composition. And so, we generally assume, and I have to go look this up, but I think we generally assume if you were measuring on a mark-to-market basis, like if you could actually measure the entire private credit asset class on a real-time basis like you can with private credit, it's in between, 0.5 and 0.6, which is high, but not one.
Okay. And then you did mention something, and there was an explanation, maybe I didn't follow it carefully. You pointed out, due to the denominator effect, a lot of allocators have diminished or held constant their allocation to private markets, and yet the amount of dry powder is ever increasing. How do I correlate those two seemingly at odds facts?
Yeah, so what I said was that they have slowed down, right? There's a large heterogeneity in asset owners out there, right? But many of them have slowed down the level of commitments, not to zero, but have slowed down, okay? In an environment where they were increasing their overall allocations. So it is true that aggregate dry powder has traced up and continues to trace up, right? But the point that I made was that as fundraising cycles have slowed down, some allocators have slowed down, the amount of dry powder, which in absolute terms has continued to increase as a percent of the installed base, right? Like if you think about all of the market as one portfolio, the percentage of dry powder related to the actual assets held has actually gone down. So, you have to normalize to the amount of private equity out there when you think about dry powder. You can't just say in aggregate terms. And so that's actually slowed down, which is consistent with not necessarily people stopping, but people slowing down their rate of commitments.
Mm-hmm. Okay. And I guess my last question actually kind of more points to a question that Mr. Polani raised. It seems like you're advocating a greater tilt towards, greater allocation towards credit at this stage of the business cycle. And I know that's a view echoed by Howard Marks and others that Mr. Polani follows. So I'm curious if our next suggested asset allocation is going to tilt towards more credit than we've seen in recent past.
Well, that's a decision. Is that a question for me or for?
I think that's more of a question for you, Mr. Polani.
I think it's a question for you, probably.
Okay.
Because it depends where you're coming from. I mean, so it's very
I was going to say that decision is made by the board.
Of course. Okay. Well, we'll look forward to your presentations in future on that. Any other questions from trustees? Any questions from the public? Anybody online? Well, thank you very much. Very, very interesting, a lot of data to absorb, and I look forward to getting the full presentation deck so we can see the missing slides. Thank you so much.
Okay, well, thank you. Just on behalf of all of us, Morgan Stanley and myself, David, I mean, it is a real pleasure and honor. I'm very flattered to be able to present to you. I hope it was somewhat helpful, and I look forward to talking to all of you one-on-one or together in the future. Thank you for having us.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.
Okay, I believe we have completed the agenda fully through agenda item 6. We are on to 7, committee reports, 7.1, Investment Committee. And Chair Chandra?
Sure. I was not present for the December 23 board meeting, and hopefully one of my co-committee members were able to provide some form of update, because I don't fully remember the December board meeting, investment committee meeting. But our next meeting's in February, and we'll have a report out after that.
Right, yeah, we did a review of private markets and
That's
and
right.
also an update from Veris on risk issue.
And the transactions cost analysis.
Yeah, okay.
And Rui gave us a very nice overview of the macro markets today, so I think we're in good shape.
Okay. The Audit Committee. Oh, sure. Do we need to vote on that?
No, they just get filed.
Receive and file. 7.2 Audit Committee. Last meeting was way back in October, so I assume there's nothing new to report unless I'm mistaken?
No updates.
Okay, very good. Governance Committee, last meeting was back in November, so I'm assuming again that there's nothing new to report?
No, and our next meeting, Mr. Chair, is again a joint governance committee meeting with police and fire.
Okay. And
Just next Monday, so.
just next Monday. And under governance is where we are reviewing the progress towards the adoption of ORS policies and
Correct.
its correlation with city policies. Do we have any update from council on the progress of that?
Yes, we will be able to present at the Joint Governance Committee our full review of all city policies.
Full review, so this is going to be a complete, okay. Great, well, we'll certainly look forward to seeing that, okay? Disability Committee. Obviously, we just voted on a disability recommendation. Is there any further?
You'll be seeing on your February meeting, on consent, 2 approvals for disability, and so that'll be coming there. And then we have item C is the important item for today's discussion, because there we've gone through with the help of staff and attorneys. We have approved rules for our procedures and the whole process of so it's basically giving us some actual guidelines of how to proceed and guidelines for people who are applying for disability retirement. And we felt very good about what was presented in the draft and are recommending that for consideration and hopefully board approval.
Okay, and is this a case where there were no procedures prior to this? This is something new or just a modification?
This is something new for us.
Okay.
Police and fire had procedures and policies and whatnot, but this is something that we had asked, the committee members had asked the staff and the attorneys to prepare for us to look at. They've done that. Maytech put it all together towards the end, and it looks good to us. We also are going in August to have on our agenda to see how it's actually working for the staff and for the retirees who are applying.
So if I may, just for the record, as a part of our governance improvement project, we sought to memorialize our disability retirement application process and procedures in writing, both for the board, the committees, as well as the members and future generations. There are a few features of the policy that are new features that are not necessarily what we've been doing in the past, so I did want to highlight that for the committee. One of them is what to do when a member who filed a disability retirement application becomes non-responsive. The committee has decided to institute the following process, which is to require that ORS contact the member at least twice per communication method provided on their application and within 90 days. And within that period, they would continue to move forward with the application rather than stall and let it become stale over time. So it would move forward with the various process of going to the IME, then going to the disability committee, as well as the full board. And the member at any juncture of that process may appear and have their case heard. Another key element is that we will be providing a copy of these procedures to the member at each of the junctures. So for example, when they first file it, they get 20 days after, or 20 or 30 days after, they would get a copy of the rules. And then when we schedule them from the IME, we again provide them a copy of the rules. When they go to the disability committee, when we set that matter, they will again get a copy of the rules, and again, when it comes before the board. So we thought that that would be a prudent way to go forward so that the members are fully informed. Two other things that the policy provides is that it gives a checklist cover sheets of the elements that must be met, and the staff and the committee's assessment of whether or not those elements are met to help focus the committee and board's consideration of those applications and those elements. And lastly, it provides the committee the sole judgment to make exception to the rules for good cause. And good cause is defined within the policy.
Okay, great. So are there any questions from trustees on the new proposed policy or the memorialization of what was existing policy? Okay, would anyone like to formulate a motion to accept this policy?
I'll make such a motion, Mr. Chair.
All right, so that's it.
I'll second it.
Very good. It's a motion from trustee Linder, a second from trustee Chandra. Any discussion on the motion? Any public comment? Hearing none, we will vote. Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Chandra?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I vote aye as well, so the policy is adopted.
So just for the clarity of
Thank
record and for the members as well, the policy, now that it's been adopted, but the procedures have now been adopted by the board, they will be effective as of today.
Yes, I assume that was the intent.
Yeah.
Okay, thank you. Item 7.5. Oh, we're going to receive and file the minutes, of course. Joint Personnel Committee, were you at the last meeting?
I was not, and we should note, there was a December meeting, and I noticed that there's only minutes present for the November meeting to receive and file. I don't know if there should be December minute meetings as well.
December is going to be presented at the JPC for approval of the JPC first before it shows up on ours.
Okay.
Yeah, correct.
Okay, so then
The other thing, Mr. Chair, that the December meeting will have is the representative from Alliance will be present to discuss how we want to proceed with getting information together about what we want in our next CEO.
Mm-hmm. And just for the benefit of the full board, it was at the December meeting that we chose a outside recruitment firm, and that is Alliance that you just mentioned. And so it was competitive. I believe there were 3 bids. It was a competitive bid.
Correct.
And we selected Alliance to manage the recruitment process for our CEO.
That's correct. That did happen at that meeting.
Okay, so we'll get.
And you can see in the attachments to the agenda, the RFPs that we did receive, and I think you'll see why we went with Alliance.
Yes. Any comments or questions on the JPC committee report? Okay, so hearing none, we will receive and file the minutes, which were the November minutes apparently. And that brings us to education and training. I think we can all see that is the Cortex report. We have the Calipers General Assembly coming up in Rancho Mirage. And also the advanced principles at the UCLA. Are there any questions about the education and training? Any proposed agenda items? Hearing none, at 11:06, we are in adjournment.
Thank you.
Yeah, I can't make
Thank you.
this one because